Good evening, everyone. This is Rich Checkan with Asset Strategies International, and I'm here tonight with a good friend and webinar co-host, Adrian Day of Adrian Day Asset Management. I think everybody knows us by now, but for those of you who don't, Adrian, I'm very lucky to count him as a friend. He's a fantastic asset manager of his eponymous asset management firm, Adrian Day Asset Management. He's the author of 3 different books on resources and global investing. He's a graduate of the London School of Economics from his native London. Started out in the newsletter industry, writing about resources and commodities and so forth and global investing. Got quite a following. Parlayed that into books and asset management, and basically you name the show, he's been on it. You name the tabloid, he's been in it, on the good side, not the bad tabloids. All right, these are.
Yeah, I don't know that I've been in the tabloids, but
No. Adrian is well known for his opinions, and rightly so. And welcome, Adrian, to the next episode of On the Move.
Well, thank you very much. Let me introduce Rich for people who don't know him again. This is sort of Rich's webinar. He started it, and I really appreciate you asking me to join you. I've known his uncle, who founded the firm, since really since the days they founded the firm in the early 80s with Glenn Kirsch. You joined the firm, I think, in 1996, sorry. I've known you pretty much since then. That's after graduating from West Point. For those who don't know, Asset Strategies International is basically a gold firm. Primarily, they deal in coins, obviously, as well as the Perth Mint certificate. And maybe you'll tell us more about that later. But before we get too deep into the weeds there, let's introduce our very special guest, someone that I've really been looking forward to having on the show because of his real wealth of knowledge on the resource market. And that's Adam Rozencwajg. He's a co-founder and managing partner of Goering and Rozencwajg. He's been dealing in, I guess that's the right word, I don't mean technically dealing. He's been an investment manager in the resource sector for 18 years now. And I read in your bio before that you were, I don't know if we talk about that too much, but you were at Lehman Brothers in 2006 and 2007. I don't know if you're responsible for them going down or if you got out before they got down. But anyway, I also noticed that you graduated from Columbia with a dual major in economics, which is not unexpected, but also in philosophy. And maybe later on in the conversation, we can say if your knowledge and understanding of philosophy has any, if it comes to bear at all on what you do. I know I'm a historian. I went to the School of Economics, but I didn't graduate in economics. I graduated in history, and obviously history has a great bearing on economics. Anyway, enough of that rambling. Let's introduce Adam. Very, very pleased to have you here, Adam, with us.
Well, thank you so much. I'm really excited to be here as well. And I'll correct one tiny issue, if I may, just because I don't want the CFA Society or somebody else to come and accuse me of misleading anyone. It was actually a joint degree. It was a joint degree that very cleverly made it seem like a dual degree. And so it was an economics/philosophy joint degree.
That's clever. Yes, sometimes I tell people I've got an honors degree from London School of Economics without mentioning that 99% of people who graduate from the London School of Economics have an honors degree. But anyway, so let's start with a very broad question, if I may, just to kind of set the scene. And when you look at the entire commodities complex, first of all, is it possible to look at the whole complex, or are the specific factors affecting individual resources more important? And then, if you can look at the whole complex, do you believe we're at the beginning of another bull market, or dare I say, commodity super cycle?
Well, what an interesting question, because sometimes I do want to bang my head against the wall. I spend all this time looking at supply and demand fundamentals of each individual commodity submarket and look at drill productivity results and other things of that nature. And then it does seem more often than not that a lot of them just go up and down together. And so you say, well, wait a second, do any of these details really matter? And the truth of the matter is that both are true. Obviously, the supply and demand fundamentals of each individual commodity market are of critical importance to the unfolding price action in that commodity. That goes without saying. There's, I suppose, some people out there who, and more power to them, who are traders and can read the tape and understand when something seems to catch a bid and have momentum behind it. But I'm very much of the opinion that fundamentals win the day. If you gave me conclusive proof that the fundamentals have no bearing on my future returns, then I would have to really find another line of work, because I'm really holding hope that they do quite matter. So why do all the commodity markets tend to kind of go up and down together if each of them are responding to their own set of particularities? And I think the answer there is of really paramount importance here, and that has to do with the capital cycle. And the capital cycle of investor money coming into and then out of the resource space ultimately determines how much new supply of that resource comes into the market. And so I think what's the common glue that holds some of these markets together, and why copper might go up around the same time as gas or as gold or what have you, is because when investors become interested in real assets and commodities, they tend to be responding to a certain set of observations in the market. They see that the traditional momentum factors maybe are starting to break down. They appreciate the value that can be created at the bottom of bear markets. They're looking for inflation protection and diversification. And so with that, they begin to look to the extractive industries to provide some of those exposures. And so as the money pours in, it at times can pour in indiscriminately to different commodity markets, and you can see them go up and down together. But ultimately, at the end of the day, when all the money comes back out and attrition and depletion starts to take hold, that's what drives the commodity cycles. And that's true in iron ore, it's true in copper, it's true in gold, it's true in gas and oil and uranium, but each with their own timelines and each with their own dynamics. So there is, I think, a macro capital cycle that drives a lot of these similarities at times, but it does pay to understand the fundamentals in each individual commodity market, because there's been times where you want to be in oil and times where you want to be in gold. And if you look in the 1970s, yes, both did quite well. If you look from 03 to 11, both did quite well. But there was times that you really wanted to have your preference in one versus the other to generate the maximum return through the cycle.
Yeah. And you mentioned at the beginning that, it's the sort of capital investment cycle that drives them. What about the lags? Can you describe how the capital investment cycle is related to the economic cycle and what the lags are?
Sure. So let me start by talking about the commodity cycle itself, because the relationships between the commodity cycles and the economic cycles are hugely fascinating. And if I had more time, I'd love to go back to school and write a master's and PhD dissertation in these sorts of things. But let's just start by focusing on the commodity cycles, because commodities do move in these huge, long cycles. They're long both in duration, and they're really, really big in amplitude. It's not uncommon to see commodities fall 90% in a bear market and rise tenfold in a bull market. And they can last for a decade or more. And I think both the duration and amplitude is unique. Lots of things move in cycles, but I've never seen anything that's quite as volatile as the commodity cycle and that lasts quite as long. Now, there's a silver lining, and that is that I think if you properly understand that commodity cycle, it's very, very predictable. And there's some very common drivers that run throughout. And because it lasts for so long and because the amplitude's so big, you can really make quite a bit of money and protect your portfolio, I think, by looking at the space when the time is right. So let's start with that. What drives the commodity cycle in general? Well, commodities, as far as I can tell, have two fairly unique attributes. The first is that all the pricing is set on the marginal unit of supply and demand. So as Richard said, I've done this, nearly 20 years. And in that time, I've seen oil go from $20 to 140 to minus 45 to 120 to 50 to 70. And in that 20 years, I've never seen an oil market that's more than 1% out of balance, either in deficit or in surplus. So if you think about, today we have 104, 105 million barrels of demand and supply. And I've never really seen an imbalance of greater than 1 million barrels per day, which means that the other 102 million barrels, I mean, that's kind of a wash, right? And I recently was in France and I visited, as one does when they're in Paris, the International Energy Agency. Other people go to the museums, but I went to the IEA. And, God
a
bless.
landmark there, isn't it? Just like this tall statue thing.
Yeah, it's, I was expecting a much more, neoclassical Haussmann style building, and it's actually quite modern and bureaucratic. I guess you should expect that. But in any event, I was really, and if you guys have followed my work or read any of our letters or seen our podcasts, I don't hold the IEA's projections and analysis in particularly high regard. And when I met all the people there, I was really taken with how sharp and bright and academic and really accomplished they all are. And I said to one guy, I said, how do you think you guys can get it all kind of so wrong when you seem to be really diligent at all this? And he said, well, you guys in the markets, you start from the top down and you say, does this market feel like it's in surplus or in deficit? He goes, I have to start at zero and I count every barrel in the world. And by the time, I counted them all, I get to a total, and that total and that total, if I'm off by even a little bit, it's the difference between a huge bear market and a huge bull market. So I need to be 100.0% accurate, whereas you guys just need to kind of get the direction right, and that's hard enough. So I do appreciate that, markets, these markets are set on that marginal unit of supply and demand. Now, the next thing that is particularly unique about the commodity markets, and getting worse or better, I suppose, depending on how you see it, is that the time that it takes for a new project to come online is only getting longer. It's getting longer and longer, particularly in the mining industry, but also, the shales were a little bit of a respite. They were known as short cycle. It actually didn't take very long to drill them, and you could bring on supply fairly quickly. But besides that, the history of the energy industry has been shale has been larger mega projects that have longer and longer lead times, and mining projects run 10 to 15 years now from first discovery through delineation, permitting, construction, and production. So you have a long lag. And those two factors together, the marginal unit of supply and demand and the long lag, means that you are in for one hell of a show in the interim. Because what happens is the market, let's just take a bear market. It's in surplus, depletion takes hold, you slowly ratchet the surplus a little bit tighter, maybe demand picks up, you have a driver that no one anticipated, and it shifts from surplus into deficit. Well, now prices start to scream higher. Supply is fairly inelastic in the near term.
Right.
And so you need to find the price that's going to ration off the next unit of demand. And obviously, as we can think of in our own lives, that's a high price, right? What gasoline price at the pump would it take for you to change your driving habits? Well, you might cut down a little bit here and there, but you ultimately have to commute to work or what have you. And so we see, and lots of people write about this, that the price inelasticity of demand is extremely steep. And so prices just move up and up and up and up. Now, at first, the market doesn't believe it, maybe consolidates, and they say, told you, this is a bear market that's been going on 10 years, not over yet. But then it kind of continues to move higher, defies expectations, and it starts to attract capital in. And eventually that capital gets put towards sanctioning new projects. However, that's when you start the stopwatch on this kind of 10 years before that supply comes online. And since there's not a capital czar to stand at the gates and say, okay, guys, that's enough now, we don't need any more, just give this time to work through the system, inevitably you overshoot the mark. And so extra money comes in because the commodity price in that time, despite now the investor money is coming in, the stocks have caught a bid, the commodities have caught a bid. So the stocks look cheaper and cheaper and cheaper, and they're doing better and better and better. And money just pours in at that point. You think back to 2005, 6, 7, 2010, 11, even after the GFC, money just poured into the space. And of course, that creates a supply response that's greater than what we need. The market then shifts from deficit back into surplus, prices collapse, projects that were underwritten at higher prices are impaired, If you use debt, which a lot of people have to do to project finance these things, they could actually go bankrupt. And all the investors at once pull their money out and say, I told you so. I told you I should never be involved in this space. It was absolutely awful. And gold miners are the worst, and oil companies are even worse, and what have you. And from that point, no new projects come on, and depletion slowly begins to work its way through the system. That's where we try to find the value. That's what we try to look for, right at that cusp. And so I think it's a very predictable cycle. It's an infuriating cycle because 10 years is far too long for any institutional manager to be able to say, just stick with it. It's coming, it's coming. It's hard to get the turns just right, although I think we do a pretty good job at it. And that, will be in place between now and the end of time, I suspect. I will answer just one question that you asked before, which was, are we on the verge of a bull market? I think unequivocally, yes. When you look at the capital cycle, we are now so far below replacement. We have starved this industry for so long. One imperfect, but fairly good indicator is just what's the energy and materials weighting in the S&P. Big bull markets top out at 30%. 30% of the S&P in 1980 was energy companies. Schlumberger was the largest company in the world. Today, it can't break above 3%. The long-term average is 11. So you're definitely have very little investor interest. Gold's the best performing asset class this year. Gold stocks up 54%. Look at the shares and the assets under management of any of the gold funds. They've all experienced outflows all year, right? So there is no capital in the space at all. But one thing I will say is that a super cycle, I don't know, a super cycle to me is a fancy word of trying to suggest it's not a regular cycle. Maybe it's going to be a big cycle, and it'll probably last longer because ESG pressures kept money out for so much longer, didn't allow the market mechanism to work. But no, it's a cycle. It'll end in tears, I suspect, around 2040, with energy probably at 20-25% of the S&P.
That's the interesting thing. You and I, and maybe Rich too, we know how this is going to end. It's not going to end any differently than any other cycle. And we know that, in maybe 10 years' time, all the companies are going to be overpaying for marginal assets, and they're going to write off those assets. We know that. But we just have to be kind of ready to get out. Rich, did you have something to add?
Yeah, I wanted to follow up on that. So you gave the answer that, yes, we're at the start of a bull market. And, in my digging prior to tonight, I uncovered that you and Lee, your partner, have done a lot of looking at previous bull markets, major bull markets in commodities. I think you cited 1929, 69, 99, and now presently. And there were some common threads among those bull markets that I think might be worthwhile sharing with the audience tonight, as well as the one component that's not there just yet. Is that
Sure.
where I'm going with this?
I suspect. I mean, I suppose, yeah.
I think it's worthwhile for them to hear, what goes into these bull markets and why you're so convinced we're in the start of one right now.
Yeah, absolutely. So this is, unfortunately, it's not going to be a short answer, but this builds on some work that we did beginning all the way back in 2015, 2016. So it's 10 years already that we've been sort of writing on this. And it comes as any good, Lee used to be good friends with a large, very well-known market strategist. And he used to say, you have to understand, I'm in the financial entertainment business at the end of the day. And so this will be a little bit of financial entertainment. And like any good entertainment, it needs a prop. And it's even better if that prop has been stolen but from somebody else. So this has all the elements of good entertainment. And what I'm referring to is a chart that we first saw published by Jeffrey Gundlach at Double Line. And he wrote that it was a ratio of commodity prices to the Dow. So just the Goldman Sachs Commodity Total Return Index and the Dow. And when you divided one by the other and plotted it over time, it traced out a really interesting cycle. And it was a really, I think, important visualization of this commodity cycle that we're talking about, right? Because we can talk about, why we think we're in a cycle and why things are cheap, and they certainly seem cheap, and investor disinterest, et cetera. But if you're going to do something that's so heavily cyclical like this, you better damn well know where you are in that cycle and have a pretty good map. And this, I think, is as good a map as any we've seen. And it started out as an observation. It showed that commodities relative to stocks were super cheap. Now, there's a problem with the chart. It only went back to 1970. And there was a reason for that. The Goldman Sachs index actually didn't start in 1970. I've been saying that for a while. It started in 1993, I think, but they recast it back to 1970. And so the data goes back to 1970. And you got, certainly the 70s, and you got the early 2000s super cycle in there. But you didn't really have a lot as far as bear markets went. You had from 80 to 99, basically. And then you had from 11 to, at that point, 14, 15. And we wanted to see more. We wanted to see if there was any, if the pattern repeated, or if it was just kind of, 1.5 cycles. And so what we did is we discovered the methodology to the Goldman Sachs Commodity Index. There's a white paper on it. It's very difficult to understand, but we figured it out. And we took commodity spot data going all the way back to 1900 and treasury data and all the different components you needed to build the total return index. And we built it. We basically recast it all the way back to 1900. Now, it turns out, I later found out that Mr. Gundlach himself had stolen that chart from Tony Beck, who used to run BCA research up in Montreal. And Tony,
what a tangled web we weave.
Yeah, and Tony and I are friendly. And so I said to Tony, I feel better, because I don't know Mr. Gundlach. And so I said, at least I feel better now that I know the original provenance was you. And he said, I don't really remember doing that. So the final word is out still. But anyway, we recast it going back to 1900. And we saw that, in fact, the pattern did repeat itself. We got the 1970s, we got the 1929 to 1940 commodity bull market. Now, that's a shocking one because it happened in the midst of the Great Depression. So very, very different, right? The 70s happened during a period of stagflation. Everyone thinks it was terrible for economic growth. It actually wasn't. It didn't keep, on an inflation-adjusted basis, wasn't great. But you still eked out some real gains over the decade. But not a fantastic period. The 2000s obviously associated with the rise of China, but then 29 to 40, the worst economic activity effectively in human history, or certainly in modern times. How could commodities have done well there? And so we saw that the pattern repeat itself, and we wanted to dig in and try to understand why. And so it started for as an observational chart, became a little bit more of a question of what are the drivers behind it. And so the first driver that we realized, kind of simplistically, in order for the ratio to fall to extreme levels, you need to have a commodity bear market. It doesn't happen with only one component here. The extremes tend to happen uncorrelated. So it happens like negatively correlated. The equity markets drop and rise, and the commodity price falls. And we saw that in every case. In every case, we also saw a period of really easy monetary policy. And that was true in the later half of the 1920s, which was a commodity bear market. It was done, we don't need to go into all the financial history, but it was done when Benjamin Strong was trying to devalue the US dollar to help Britain go back on gold at its pre-World War I exchange rate. It happened with guns and butter through the 1960s, and it happened with the Greenspan put and into the everything bubble of the easy monetary conditions of the early 2000s, of the late 1990s. So you have easy money, you have a stock market rally, and you have a commodity price fall in absolute terms. The other thing that we noticed, which was kind of interesting, was that tech was always the beneficiary of the largesse. So in the 20s, it was radio stocks. In the 60s, it was semiconductors. And in the 90s, it was the dot-com era. And today, obviously, it's the hyperscalers and everything of that nature. And we said, wow, that's fascinating. It gives us a little bit more confidence that perhaps we're seeing something repeat itself, not just an observation anymore, not just, look, these things move in a band and we're at the low end of the band, although that's nice to know too as an indicator. But actually, it seems as though there's some commonalities that go into this. The other thing, of course, is that every time that commodities get really cheap relative to stocks, it represents a really good buy in commodities, not just in relative terms, which it would by definition be true, but also in absolute terms. And that was also true during the Great Depression. Commodities and commodity stocks were not just did better than the market. If you actually bought a basket of commodity stocks in 29 at the peak of the market, right before the stock market crash and the Great Depression, by 1938, 1939, your basket of stocks had doubled, and the S&P was still off 50%. So big differences here. The next question that we always got asked, what triggers the next bull market? And so we looked back and we said, well, what did 29, 69, and 99 have in common? And what they all had in common, and it surprised us, this is not what we kind of anticipated, they all had major changes in the monetary system, major changes in what we call the monetary regime. So what do I mean by that? Well, from the end of the Napoleonic Wars to World War I, you had the classical gold standard, a hard gold standard led by the pound. And every European country, including the pound, suspended its gold standard for World War I, which is not uncommon in wartime. And at the end of World War I, Britain tried desperately, or debated endlessly, and then ultimately decided to go back on gold. And Churchill was the Chancellor of the Exchequer at the time. He later went on to say it was his biggest political regret, worse than the Dardanelles, worse than anything else that he had done. But he really, and against the advice of Keynes, decided to try to put Britain back on gold. Now, the problem was that Britain's cost structure, because of union impacts and general inflation, it was really hard to bring that back down. It's really hard to prop up the pound enough. You would have had to have massive, massive economic hardship. And there was some of that for sure. But what happened was that the Americans tried to devalue the dollar to help prop up the pound. And Strong printed money like crazy through the 20s. That became known as the first quantitative easing in the newly formed Federal Reserve Bank. And it was culminated when he decided to give the stock market what he called a shot of whiskey. And that was that he was going to print money despite the fact that the economy was doing quite well. And sure enough, the stock market just took off. It was very controversial. He died suddenly, I think 28, maybe late 27, early 28. And immediately all the people at the Fed that were against his policies reined in the money supply, and the Depression, if you believe Schwartz and Friedman, the Depression followed, and Britain had to give up the ghost. That was the end of the British gold standards. Fast forward to 1969. In 1968, late 68, Johnson, because of running these huge budget deficits, and then eventually the French threatening to take their gold out and actually taking their gold out of the Federal Reserve System, Johnson passed a law through Congress, or pushed Congress to pass a law that said that the dollar no longer had to be backed by gold. And that was the end of Bretton Woods. Obviously, Bretton Woods didn't officially end until 71 when Nixon had the gold shock, and he said you can't exchange your dollars for gold anymore. But really, if you look, I mean, it's like taking out any reserve requirements for banks. And then 2 years later, the banks don't have any money left, and so they can't redeem depositors. When did that really happen? Did it happen when you said the law that they no longer had to have reserves, or when they actually ran out of money? Probably both, I suppose, are important dates. And that corresponded again with the end of the commodity bear market in late 68, early 69, and then it was off to the races by 70. 1999 was a little bit more of a tricky one to identify, and to be honest, I didn't realize or appreciate this. But what that was what Russell Napier calls the no-name revolution, where effectively following the emerging market currency crisis in the late 1990s, all of the Asian currencies decided en masse to devalue their currency relative to the dollar to help spur their exports. Before that, they had kept the dollar peg, and they had kept that dollar peg largely at fair value. The idea being that if they ran into any hot money troubles, the IMF and World Bank would bail them out with swap lines. They ran into hot money troubles, and the IMF and World Bank proposed austerity and getting their house in order, and they said, well, that's enough of that. And they changed the system, and so they pegged it at a below market rate to spur exports. We maybe don't think of that as important as the Nixon shock, but it resulted in several $1 trillion in treasuries effectively flowing east, most notably to China, but to other Asian economies as well, and persistent budget deficits being allowed to, or forced to, flourish in the United States, and was a huge lead up to the housing crisis, and frankly to the situation we find ourselves in today. So I would say history will go and call that a major shift in the monetary system as well. So as early as 2020, we said, look, I don't know why this happens, but commodity bear markets end with major shifts in monetary systems. So watch the monetary space. And for a couple of years, we were convinced that all the rumblings by the BRICS countries of a alternative currency regime, perhaps that was the catalyst that we were looking for. People like Luke Grauman have been saying that for a long time. We only started to really see mounting evidence of that around 22 or 23 or so. And now I think more likely than not, it's going to be precipitated by the United States itself, a doubling down on the dollar, what have been called these Mar-a-Lago Accords, which, were bandied about in the press last fall, November, December, which feels now like an eternity ago, but I think is still in the offering. So I suspect that, until proven otherwise, I would think that it's likely that monetary regime change is going to come from the US.
Right.
Yeah, so we're looking for the spark.
I think so. And, that raises an interesting question of, I kind of alluded to it a second ago, but why? Why do commodity bear markets end with major changes in the monetary system? And I think the answer to that is, there's a great book written by 3 authors, Lee, and Cold Iron, called The Rise of Carry. And it talks about these carry regimes and carry bubbles. And I think that that's kind of the untold other half of the commodity bear market. There are these moments in time where carry trades just run amok. And the thing about a carry trade, everyone thinks of a carry trade, you borrow in yen and you invest in Australia, right? You have a high yielding asset and a low yielding or low cost funding currency. And so long as the FX doesn't kind of blow up in your face, you can clip a coupon. So you lever that up and off you go. But what these guys very astutely point out is that, in fact, a carry trade is a more general type of trade in which the participant is levered short volatility. So basically, so long as tomorrow resembles yesterday, you clip a coupon. That's a carry trade. That's how they define it. And I think it's a great definition. And they go on to extend and say that, based on that definition, a lot of things today are part of a carry trade. The S&P certainly is. Momentum, what worked yesterday works tomorrow. That's a great investment strategy for the last, decade or so.
Till it's not.
Yeah, until it's not. But every carry trade is until it's not, right? It's picking up the proverbial pennies in front of the steamroller. Large cap over small cap, right? That's an anomaly. Normally, small cap and mid cap do better than large, but in carry regimes, they don't. And the reason they don't is that if what worked yesterday keeps working tomorrow, then you're going to disproportionately grow your large companies, and they're going to grow and they keep working because they work. Momentum works very well. Mean reversion does not. Growth works very well. Value does not. Passive works very well because that's tied to large cap and momentum. And so on and on and on it goes until the system just breaks down under its own weight. And I think that that's the moment that we find ourselves in. It needs cheap liquidity and it needs low volatility. So when does that end? It ends when tomorrow doesn't resemble yesterday. It ends with some kind of a shock, some kind of a shift, typically because the plumbing of the money system is now so overwhelmed because the momentum has no natural modulator. There's nothing that kind of brings it back in check. It just feeds on itself and grows and snowballs until it can't anymore. Right. And commodities and inflation assets tend to be the other side of that. They're completely out of favor in those periods.
Good point.
Could I, sorry, do you have a question?
No, go ahead, Adrian.
I was going to say, could I just maybe switch gears a little bit? I think this background has just been fascinating. But let's sort of focus, if we may, Adam, on specific commodities. You've obviously made some really good calls, been a little early maybe on copper, on uranium, also on the end of shale. That was another maybe a little bit early, but now it looks like a very prescient call. Can you tell us? I'll get back to your discipline in a minute, if I may, but maybe. Just tell us, what are your favorite commodities or resources right now on a maybe 3 to 5 year sector? If you had limited money, where would you focus?
I do have limited money, it turns out.
Well, we all do, don't we?
And how are we positioned? Maybe it's a cop out, but the way we're positioned is obviously the way that we feel as far as the best likely performance of commodities going forward, the areas we're most excited about. And we can get to each of them, all of them, any of them in due course. But the way our portfolio is laid out right now, our core themes are crude oil, US natural gas, uranium, and gold. I think those all have fantastic 3 to 5 year forward performance in them. And the one that is particularly exciting today, I would say, is really the oil market. And the reason that I say that is a little bit of historical context, or first I'll start maybe with the current landscape and then a bit of historical context. So oil today is trading at really cheap levels. When you look, at the real price of crude relative to its history, it's in depressed territories. When you look at another key ratio that we like to look at, and Richard, I suspect by your background, you would agree with this. And instead of quoting it in US dollars, you quote it in ounces of gold. If you believe that gold has remained a currency and an important one, then presumably its price in gold ounces is very, very important. And certainly in gold terms, oil is ridiculously cheap. Essentially, in the last 3 or 4 months at its lows, crude got to levels we'd only really seen surpassed in both real dollars and relative to gold in the COVID lows, when obviously oil went negative. And I don't never say never, but I don't anticipate seeing that again anytime soon. That happened for a lot of very particular reasons. So crude's really cheap. And historically, when you look at crude being this cheap, it's corresponded to periods of what I would call very obvious surplus in the market. And what do I mean by very obvious surplus? Well, at its simplest, inventories have been rising. Inventories have been growing sharply, meaning that there's been more supply at that moment in time than demand, and the difference winds up in stockpiles. And you can see it. We published it in our last quarterly letter. It's a really neat chart. I haven't really seen it anywhere else. But in all of these periods where you get these kind of gap lower in oil prices, it's been you could see the data why. And in order to take a bullish view, you had to be a little bit forward looking. You had to say to yourself, okay, look, yeah, inventories are bad now. The market's in surplus today, but I see that surplus evolving. I see something changing. Today, you have oil at these depressed levels, and inventories have been relatively static. In fact, they've actually been falling a little bit recently, which we think we understand why. 1 or 2 other analysts out there, I think, is on to it. But in general, I mean, everyone just talks about this surplus that's in place today. It is not registering in the numbers, let me tell you. Inventories are very low and now falling, and yet you have this depressed price. So just from a trader's mindset or an investor's mindset, I think you're being given really good odds here. You're being given the depressed price without any of the depressing fundamentals. Now, could it be that the market is anticipating correctly a major deterioration in oil market fundamentals, a huge surplus out on the horizon in the next 3 to 6 months? It could be, but not to be cruel, the market has not been a very good predictor of the forward trajectory of oil fundamentals. It would be the first time that the market looks 6 to 12 months out and gets that one right and calls a major bottom. So instead, I think what's happened is you have a huge narrative that's developed between drill baby drill with Trump, between what's happening in the OPEC countries, between the sort of Damocles of electric vehicles hanging over your head, and the idea that, yes, we've had a few rallies, but in general, the oil market's been frustrating over the last 15 years. And I think that there's this view that you should just stay out of the sector and not get involved. And that's why prices have been low. And that's where the historical context comes in. Because something's happening in the oil market today that has only happened twice before, and each time has been the only thing that matters in oil. And what is that? The big source of non-OPEC oil supply is now beginning to slow. So that's happened twice before. And in each case, when that happens, the result is that OPEC begins to gain market share. And with that market share, they gain pricing power. And they typically use it because they have to, on the flip side, deal with lots of periods of time where being a cartel is not particularly fun at all. And they have to give up revenue by, cutting back production and things of that nature. And so then every once in a while, they start to gain market share, they gain pricing power, and they're pretty much always have decided to use it. Sometimes they've used it violently, like they did in the 1970s with 2 big oil shocks to the West. More recently, in the 2000s, they used it a little bit more benignly, raising prices quite high, generating a lot of money for themselves, but not necessarily cutting off supplies. But that's what happens when non-OPEC oil supply growth slows. So the first time it happened was in 1970, when the US, and up to that point, the US had been, the be-all and the end-all of the oil business, basically, since Colonel Drake drilled the first wells in Oil City, Pennsylvania in the late 19th century, all the way until 1970. And then crude production in the US, unexpectedly, about 11 million barrels a day, stopped growing. Now, I say unexpectedly, but there was one Shell geologist who all the way back in 1955 gave a speech that became widely known and criticized and still remains so to this day. His name was King Hubbert, worked for Shell. And he tried to model when he expected an oil field would roll over. He said, look, an oil field starts at zero production. It has to end at zero production when it's all depleted. And if you start at zero and you end at zero, and in the middle it's not zero, you have to have a peak. And where do we try to estimate that peak to come from? And he used all kinds of mathematics. He was widely ridiculed for being, I guess, too top down, thinking about a basin in its entirety, not thinking about well by well, not using the right, differential equations and calculus that the industry liked to use. But in 1955, he said 1970, US is going to roll over. And it did. It did. It was completely unexpected, but it did. Now, the reason that I want to bring that up, and I'll get back to it in a second, there was a huge flurry in the United States, all the way up to Nixon. And there's a view that, look, the reason that oil production has rolled over, stopped growing at that point, hadn't really rolled over, but stopped growing. The reason that it stopped growing is that we've neglected the energy industry for too long. We made it too hard to drill wells, too much regulation. And at that point, there was still some price control. And so ironically, today it's very different, but there was a feeling that let's let prices rise, take off the price cap so we can incentivize the companies to get back to work. And he spoke to the industry, and the industry said, look, if you make it easier for us to drill and you give us more money to do it, we're going to drill a hell of a lot of wells and we can get production to grow again. I promise you that. And he did just that. And the industry got to work. They raised the rig count from 700 rigs in 1970 to 4,000 rigs by the end of the decade. And production fell by 30%. And the reason it fell was that it wasn't a regulatory issue. It wasn't an economic issue. It was a geological issue. And it's very difficult to fix a geological issue other than to put money to work at exploration and find new fields. So that's what happened. And just as everyone thought we were running out of oil in the late 1970s, sure enough, all that money was put into exploration and development. The North Sea and the Cantarell field in Mexico came online. And they were great fields. And production started to grow again. And we found ourselves back in surplus and prices fell all through the 90s. And using the same methodology that Hubbert used in 55 to predict the US in 70, you could make the same analysis in the mid 90s and predict that by 2003, 2004, those two fields would roll over. Sure enough, they did. No one saw it. The IEA had 3 or 4 back-to-back years in the early 2000s where they were calling for 1 million barrels a day plus of growth. None of that happened. Production rolled over. Prices went from 11 to 145. We're in the third moment now. The shales have been 90% of all the non-OPEC growth in the last 15 years, much more concentrated than the US was in the 50s and 60s, much more concentrated than the North Sea and Cantarell were in the 90s and 2000s. And there have been really big fields. However, immense is not the same as infinite, and you can apply the same methodologies. You have to amend them a little bit, change them a little bit, and we use some new sophisticated techniques too. But we concluded all the way back in 2019 that 2024 would be the peak year for shale. And so, Adrian, you said that I was early to that call. I want to be clear on one thing. Since 2019, we said that 2024 would be the year. So we've been saying it a long time, but we didn't say that it would be imminent every quarter for the last 30 quarters.
Of course.
But it serves me right. I shouldn't look that far into the future. But anyway, it seems to now be here. So every shale field in the US has rolled over year on year, except the Permian. The Permian went from 1.2 million barrels of growth year on year to now it's at 140,000 barrels of growth year on year. This is like the most slow motion train wreck I've ever seen. No one, I get calls all the time. People say, I thought you said it would roll over. I still see it's growing. It is like a straight line down and to the right in terms of year on year growth. Sequentially, so month on month, it has peaked now 6 months ago. And I suspect year on year, barring a major shift, which I don't see, that the year on year number will probably turn negative in the third quarter. So it's over. It doesn't mean that those are going to go to zero. They're producing 11 million barrels. It's a big number, but they're not going to go to zero. But the growth isn't there anymore. That has gone now to zero. And historically, that's a time when crude prices do well. And I think that that'll be the same this time too.
I mean, I should have said that you made the call early.
Yeah.
But when you made the call, I think it's fair to say you were certainly the first person I heard make that call. And I think it's fair to say that when you made that call, it was a very contrarian point of view.
Very
You're
much
also contrarian on uranium and contrarian on, and you still are contrarian on copper, that's for sure. But let me just ask, let me step back a little bit, if I may, and just ask, what is it about your methodology, your discipline? What is it that enables you and Lee to make these really quite, in many cases, very dramatic contrarian calls, to make them early and to be proven right? What is it that you do differently than other analysts?
Well, it's a good question. I think there's probably a couple of things there that all come together. And, I've worked alongside Lee for 20 years. He's been doing it for 35. When I joined Lee, I was, 2 years out of school and pretty fresh and green, not ESG green, but just, green.
The good kind of green.
The good kind of green. And, I've really kind of learned everything I do from him, and we very much have a similar approach. And I think the only way, once you kind of appreciate his approach and my approach, the only way that could work is if we're sort of wired the same way a little bit. And what I mean by that is that we really are contrarians. We really do not find any safety in the herd. I joked with somebody on a podcast a while ago that thank God I was born as an investor in the 2020s and not as a hunter-gatherer on the plains thousands of years ago, because I would have been picked off very, very early on. But I think it is kind of a benefit and a virtue. I think we're value investors at our core, so we like to look where other people are not looking. And I think that's kind of probably the first area, is that we seek out markets that are out of favor. We seek out places where people have said, oh, you can't invest in this anymore. Like, I'm not a telecom analyst, but JP Morgan 2 years ago said that Chinese telecoms and media companies are uninvestable. If I were a telecom analyst, I'd be looking all over those right now, right? That always perks up our ears. And so I think knowing where to look, just by knowing where everyone is so adamantly against, is a good starting point. Now, of course, that's not everything, because you don't want to go, sometimes everyone's right. And that's the worst, is to do something, to be a contrarian just for contrarian's sake. But I think that we're willing to look in places where other people aren't. That's number one. Number two is that I think that we're very, very good at winnowing in on what's important, what's the important driver, and then going very deep on that important driver and understanding it better than anybody does in this space. And so at times, like, this predates me, but like in the early 2000s, Lee became enamored based on a conversation he had with the then CFO of Freeport, Richard Atkerson, now CEO, but before it was run by a guy named Jim Bob Moffett was the CEO. And Richard was, at that point, obsessed with the idea that every ton of rock that was going through the mill contained less copper in it than the ton before. The head grades were falling, and they were having a hard time finding enough high-grade rock to keep the head grades up. And he said, well, that's really interesting, because if there's a common thread that runs through some of our stuff, it's depletion. I think we're fascinated by depletion. Make of that what you will. And so Lee set out to construct this head grade index, where he modeled every mine on the planet, except for China. We didn't have good data in China, and tried to compute what the average head grade, how much copper per ton of rock was going through the mill in each of these mines, and construct a global head grade index, which was the weighted average of that. And at the time, he enlisted some data providers and whatever, and nobody had done that. Not a single person had done that. But he was fixated that this was, if all of a sudden you put on all the new mines that were due to come online, you looked at demand, then yeah, the market was in surplus. But if your base was declining by 1% per year, then all of a sudden you were in deficit. And everyone hated copper at the time. It was super cheap. The companies were struggling to make money. And so what a great investment if that's indeed correct. And so they spent a ton of time modeling it. And it turns out that, yes, that was correct. And now that's a really widely quoted statistic, is this head grade declines. But Lee was the first to do that. Similarly, looking at the shales from very early on both gas and oil, we said to ourselves, this is an unbelievable, nearly unprecedented asset in its size and scale. However, it will one day run out. And so we better understand these things to try to figure out when that day might come and develop techniques and frameworks to help us understand. And we went very, very deep in that. And ultimately, we built neural networks to help us try to analyze reserves per well and the number of wells that you could wedge into these fields and stuff like that. And, we've just been fixated on that. So I think it's first is the ability to look in places that other people don't want to look at. And then secondly, the idea of really fixating on what's important and letting everything else go. Again, with these commodity cycles, I think the idea that these cycles repeat themselves with such regularity and with such common drivers that we said, look, that's important. Let's spend huge amounts of time. I mean, if you really think about it, I probably spent 9 months cumulatively studying commodity cycles that had no real bearing on a single investment decision that we made, other than to be bullish in general on where we were in the cycle, right? But that's ultimately going to be one of the most important drivers going forward, and understanding that became crucial. So I think that's
Sounds like a lot of work.
yeah.
It sounds like it's important to be obsessive compulsive too.
Oh yeah, I don't know about that, but it's certainly important, and I would say critical to have a passion for the space, because lots of people's eyes would certainly glaze over. The last thing that I'll say just before we kind of move on, maybe the third thing, is that we've been doing this and only this for an awfully long time. And so I think that one thing that we do a little bit differently to our benefit at times, obviously our detriment probably other times, is that I think that we're able to conceptualize a much wider range of outcomes in terms of where the commodity price could go. So like we got involved in uranium, it was $18 a pound. And people said to us, what's your price target on uranium? We said, well, look, at $18, you have one operating mine in the world, publicly traded. Another one was private at the time, now public, Kazatomprom in Kazakhstan. You had Cameco in Canada. You had Olympic Dam, where uranium was produced as a byproduct credit for iron ore by BHP in Australia. So that's going to go forward, because that's just kind of like a kicker, right? The steel or the iron ore makes the money there, and uranium, they just kind of get a little bit of a sweetener on their price. Fine. So you have one major company in the world, Cameco. Its cash cost was $25 and the spot price was 18. So that's an unsustainably low price. If your only company can't make a cash profit, that's too low. So that gave us.
Can't make that up in volume, as Rick Rule says.
You cannot make that up in volume. Yeah. So that became, a fruitful place to begin looking. Yeah. The next question is, what's the price target? Where does the market settle in an equilibrium? Well, if you gave the market enough time and enough capital, you could bring on enough uranium to meet global demand at then it was about $85. Now with inflation, it's probably about $120. $120 a pound, or 75, 80 then, let's call it, be fair, $80 then, with enough time, meaning you're overshoot to the upside, you'll go past fair value because of the price inelasticity we talked about, but with enough time, $80 will balance the market. Here you are at 18. If you looked at any analyst report, even the really bullish uranium analysts at the bottom, they were super bullish at $25 uranium in their price decks, right? Like we were the only idiots that would say that you could go up fourfold in a commodity that everyone thought was going out of business. But we appreciated that the range of outcomes are big. How many people thought that gold could get to $3,500? Very, very, very few. How many people, when oil came out of the COVID lows and it was sort of stuck for a little bit at $30, thought that it could ever go past 100 again? I mean, literally nobody thought that it would ever see 100 again. They said the high was it. In 2021, every energy analyst in the world said that 2019, in retrospect, would mark the high total for global oil demand. We would never regain the 19 highs. We broke through them in 22, 6 months after they made the estimates in 21. So I think it's expanding that range of outcomes, having seen a lot of crazy stuff, allows us to perhaps take a bit of a wider view than other people.
Well, I want to focus you, if I can, on something that I'm very passionate about. You could probably take a look at my background and figure out where this is going. Out talking to people for several years now. 3 years ago, people told me that gold at all-time highs was expensive. They were going to wait for a pullback. I told them at all-time highs, it was dirt cheap. Adrian's heard this for years now. 2 years ago, same thing. Gold at all-time highs. It's too expensive. Waiting for the pullback. I told him it is dirt cheap. Silver's even cheaper. And then last year, same thing. Gold at all-time highs, broke 3,000, or the beginning of this year, if you will. I told him it was dirt cheap. Western investors not in this. We've got plenty of room to run. We haven't even started yet. Do you think that investors that have been sitting on the sidelines waiting for that dip have waited too long? Is there something in their future? Should they get in now? Should they just wait this one out?
No, they should absolutely get involved. The gold is now starting a bull market, and the question is, where does it end? And in my estimation, it's going to end with 5 figures on the gold price. I suspect not 6 figures. That might be a little bit too high, but 5 figures on the gold price.
I'll take 5 figures.
And we can debate why and exactly what the framework should be, but basically, gold. So first of all, everyone loves to hate on gold because they say, it doesn't create anything, doesn't create any interest, compounding, no cash flows. And so without cash flows, you can't create a value to it. And I mean, first of all, I find that a bit silly because, I mean, first of all, none of the commodities create any cash flows in and of themselves. But even more importantly than that, the US dollar doesn't create any cash flow on itself. A treasury bill does. Right. And you can lend gold and earn a rate of return on lending the gold, just like you can earn a rate of return on lending your dollars in the form of treasury bills. So, I mean, the gold is a currency. It's a currency which at times has been overvalued. At times it's been undervalued. And a more interesting debatable question is, at times has it been a more relevant and less relevant currency? I don't know. Some people would say yes, from 1971 to call it the last 5 years, its relevancy as a currency has gone down. I would say actually not. If you look at the price of a house and you look at it in dollar terms, it's amazing how many people can intuitively take the logarithm of that and say, oh, well, that's compounding growth. I get that. But if you look at it in gold terms, it's a much more predictable, steady price. It's a lot more intuitive. So you can make the case that gold never stopped being a measure of value and effectively a currency. And all we've done is reprice gold relative to the dollar and to help facilitate transactions. But
It's a dependable measuring stick, unlike every other measuring stick out there. Value.
Oh, absolutely. No, if you look at, to me, the most incredible thing, I think is so fascinating. If you look at the price of things in gold, and you take them back 100 years, I would intuitively say that there would be a dislocation in that price chart the day that gold stopped being money, before and after. And you'd have to kind of adjust it and show 2 charts or something like that. You could not find the day that gold stopped being money if you took the price of an automobile, if you took the price of, they always say a fine man's suit of clothing, which, okay. If you take the price of a house, whatever, you could not find the date. If you took the axis off, the date axis, you could not pinpoint 1971 when gold stopped being money. That's really weird. That's really weird. You could definitely pick the day if you looked in Venezuelan pesos, the day that you had massive inflations and dislocations. You could find the day when the Colombian currency collapsed, but you can't find the day that gold stopped being money. It doesn't show up. And so I think that gold never stopped being money, and I suspect it never will. However, even with that all as aside, I think that as a currency, you can look at its relative strength or weakness, undervaluation and overvaluation, relative to stuff. And one of the most notable and I think easiest things to compare it to is how much money has been printed out in the world. Your stock of dollars versus your stock of gold, your stock of global financial assets relative to your stock of gold, or your GDP, nominal GDP relative to your stock. And by all measures, gold's awfully cheap. And it has been for some time, right? That's the knock on that analysis, is that it has been for some time. But the valuation there is very clear. It's super cheap, undervalued. A fair value on gold relative to stuff, pick whatever stuff you want it to be, is probably close to $10,000. You could make the case it's a bit higher than that, depending on whether you want to take excess reserves out of the system and stuff like that. We operated a gold standard on as little as 25% gold backing. Believe it or not, the US dollar at different moments in time has been 170% backed by gold. That's a weird anomaly for another day, but it happens when gold flows into the US and under Bretton Woods, and the US government didn't want to print money, risk inflation on the back of that. So we've had these periods where the dollar's been backed 170% by gold, 25%, which is a more normal gold standard. Britain ran a gold standard on 25% gold coverage for a long time. If you put it back to 25%, you're at $8,000 or $9,000. If you put it back to 50, 60%, you're obviously at $15,000. And if you put it in a speculative panic high at 170%, you're at 20,000. So it's cheap, and there's a big bull market out in front of you. I think the bull market started, and I think it's hard to put the genie back in the bottle now. So the question was always the timing. When would that undervaluation begin to work itself off? And I think that train has now left the station. So I think that maybe it pulls back, maybe it doesn't. I don't know. But if you buy gold now, I'm almost sure that you'll be glad you did in 10 years.
Yeah. Adam, in all your conversations, you've hardly ever mentioned a company other than Cameco and Kazatomprom.
Yeah.
To what extent do you do company analysis on top of the commodity analysis?
Oh, we do a lot of company analysis. I don't often talk about companies, and that's not because we're so alpha generative that our names are big top secret. We disclose all of our names, but I mean, first of all, frankly, it's a bit of a compliance nightmare. Second of all, I think that people in a wider audience tend to be awfully fascinated with the commodity stories themselves. So I'm happy to talk through stocks if that's something on a one-off basis. But in general, and particularly in our writings, we made the decision a long time ago to not talk about stocks. And I think from there, people came to know us from that kind of top-down view. But no, we spend a huge amount of time. We probably meet, 200 management teams a year. A lot of our returns actually come from being in the right stocks. A lot come from being in the right sectors, about half and half. Okay. Over the long term. So no, we do a lot of work on the stocks.
That's fair enough.
So Adrian, what I was going to say is I know you had one more question you want to ask, because I think Adam is very bullish on platinum, which is getting a lot of attention here lately. You're probably ahead on that curve as well. Maybe you could tell us a little bit about why you're so bullish on platinum right now, and then maybe we can get into some of the questions that are piling up here from the attendees. What do you think?
Sure. Yeah, sounds good.
Okay.
Look, the story on platinum is kind of like the hallmark of all the stuff that we've been talking about. It's a market that's fallen precipitously for a long, long, long time. If you're a South African platinum miner, which is where all the platinum effectively comes from, you can barely make money. You're at that point, that pain point, particularly 6 or 7 months ago. You've seen a rally in platinum prices now, but 6 or 7 months ago, you're at that point where almost no one could make any money, to say nothing of reinvesting in the next generation of platinum mines. Robert Friedland and Ivanhoe actually are moving forward with the only real new platinum mine in South Africa as well. But outside of that, I mean, nobody has any interest or incentive. Platinum used to trade at a big premium to gold. Now it trades at a massive $1,000 plus discounts to gold. Is not uncommon. And like most commodity bear markets, a narrative begins to emerge. And in this case, the narrative was that the electric vehicle would displace the internal combustion engine. And because of that, a huge industrial demand for platinum, which goes into the autocatalytic converters of internal combustion engines, would go away. You had a little reprieve for a while with the prospect of hydrogen fuel cells, which actually do need PGMs. But then everyone realized that it's awfully difficult and makes no economic and thermodynamic, energetic sense to drive around a hydrogen vehicle. We can talk about that if you're interested. And so, the PGM bid and rally kind of faded. And that's where it kind of languished until we started to look at it and say, look, first of all, not only do we not believe the EV story, and we really don't. And the reason that we don't is that for us, a new technology can only displace an old technology if its energy efficiency is better. We've never had an example where we've moved in the other direction.
You can't force it with subsidies.
You certainly cannot force it with subsidies. And I think what's so fascinating is that when it does work, it works on its own very quickly with absolutely no subsidies at all. The advent of the jet age, people think today kind of naively that the reason that we went from steamship crossings to jet crossings to go across the Atlantic was because it's so much faster. But that has absolutely nothing to do with it. It had to do with the fact that it was about 80% cheaper in megawatt hours or kilojoules, what have you, per passenger mile to go by jet than it did to go by steamship. And how do I know that? Well, we were able to get the time cut in half again with the Concorde. Nobody took them up on that offer because that was a horrendous slip backwards in energy efficiency.
Gotcha.
So it's not about time. I mean, obviously it's a nice byproduct, but it's really about the energy efficiency. The same was true. You know, there's a great story, which I think is so cool, that for a long time, people would plow the fields, and everyone had this like great aspirations that animals could plow the fields and liberate humans from not having to do such backbreaking work. But when you looked at the amount of energy it took to feed the animal, and then the energy loss from the early harnesses, which went around, obviously, you know, the animals' necks, you were losing so much energy through that, you know, bad design or early design, let's say, that the net energy efficiency of moving to animals, once you take into account all the energy needed to make the grains to feed them, et cetera, was worse than humans. So they never took off. It was only until they were able to redesign the harness that the net energy efficiency tipped positive, and animals displaced human labor within like 3 years on a global basis. It was like that, you know, but it's all energy efficiency. I mean, the same was true, frankly, of the steam engine. You had the steam engine for many, many years. I don't know if I want to say centuries, but probably centuries, using wood as your fuel source, but the energy efficiency was not good enough. And it was only when we moved from wood to coal that the energy efficiency had tipped in that favor. And so you had a massive proliferation of the steam engine as anything other than a novelty. And so when you look at EVs, they're not as efficient. When you take into account the line losses, when you take into account generating the electricity and then making the battery, you're better off in the oil economy. And because of that, it's very difficult to get anything other than either massively subsidized or virtue signaling purchases of electric vehicles. Now, hybrids, on the other hand, hybrids are wonderful, because hybrids, particularly standard hybrids, not plug-in hybrids, but just regular old hybrids, they have a tiny little battery in them, very cheap to manufacture in energy terms. And what you do is you use that little battery and an electric motor to capture all the wasted forward momentum that gets effectively lost to the brakes in the form of heat when you slow down the car. You capture all that and you use it, and you end up getting fabulous fuel mileage at next to no incremental cost. So it's great. Now, it turns out that hybrids are extremely PGM heavy because of all the starting and stopping of the engine. Requires a lot of PGMs to capture the emissions and the restarts. And not only that, but you've never needed a subsidy to get hybrid vehicles going. They've been huge proliferation adoption. And in fact, when you look at today, the majority of what they're calling electric vehicle sales growth outside of China, because China's a little bit of a different story, hybrids have really been the big winners there. So here you have a market where the prices have fallen so badly that the poor remaining miners can't even make any money. No one's investing in a new mine except for Friedland. And the price is extremely depressed relative to gold, let's say. And the narrative that's built around it is wrong. And so that became something we wanted to get involved in. So we did earlier this year, late last year.
Fantastic. Good for you and your clients.
And you think there's more to go?
Yeah, absolutely. Because again, you know, it's going to take time to write the supply side of this story.
Well, Rich, just before you go to questions, can we just ask Adam to tell us briefly about, you know, it'd be unfair if he didn't have a plug for his services. I mean, are you separately managed accounts or a fund?
We have a fund.
We have a subscription, you know, tell us.
Well, you can subscribe to our research. It's free. So
I know the answer. I wanted you to say it.
Yeah. So we put that in the public domain. That's always been a big part of what we do. We have all kinds of podcasts and interviews as well that you can see us on. And then, we have a 40 Act fund in the United States, a mutual fund. It's easy to own. It's on all the major platforms. And we have a UCITS fund as well now for international non-US investors, available in most jurisdictions. And then we do entertain separate accounts. We run several of them. They tend to be larger, more institutional. But if there's any institutions listening that have interest in that, then we certainly do that and have done that for a number of years.
Well, come on, give us a symbol of your fund.
GRHIX. GR, like Gehring and Rosenzweig, H, I don't know what that stands for, IX.
Okay, thank you, thank you.
And how do they get a hold of you? Just is there a website, email?
Yeah, you can go on the website, thanks to the marvels of Google and AI. If you type Gehring and Rosenzweig even probably 10% right, you'll find your way to us. And
I think I can only get 10% right with that.
yeah, that's fair. GOROZEN, GoRozen.com. And you can find all of our contact information and stuff there.
Okay, thanks. And we'll put this in the email that is sent out.
Yeah, so just so everybody knows, there'll be an email goes out tomorrow. It'll include the link to this full webinar for a replay in case you wanted to go back, visit it, or if you missed part of it, etc.
And if we may, would we be able to include your graph on commodities versus?
Yeah, absolutely, for sure. I'll send that over to you so that you can post that.
Okay, thank you.
That'd be great. Thank you. So there are a few questions that have kind of built up. I'm going to read them just in order, I guess, if that's okay, as opposed to in any particular, I guess, genre. First one is from Adrian, not Adrian Day, Adrian Cantwell. He says, parts of Africa are already becoming off limits to Western investors, but are there currently acceptable global jurisdictions that are at risk of nationalizing commodity production in the next few years? So he's basically saying Africa has already got some nationalized areas. Is there any place right now that's on limits that you think might be coming off limits in the near future?
It's interesting. When commodity bull markets really get going, we definitely see the threat and potential rise of nationalization. The big one that's happened so far this cycle has actually been, in Panama, when Cobre Panama was effectively taken from First Quantum. That was a little bit unusual. Normally, not to be cruel or paint with a broad brush, but normally what happens is a country will nationalize a mine for its economic value. And typically what you want to do if you are a government that is looking to do that, you want to wait until the company has spent the last nickel investing in that mine, and that's when you take it over. In the case of Cobre Panama, it was more of a green initiative to worry about environmental degradation and remediation, and so they actually nationalized that mine and shut it down, which is very unusual. So that's, I think, kind of been the poster child so far this cycle, but there's obviously some other examples as well. Look, I suspect that you'll see creeping increases in supernormal profits, taxes, and things of that nature as the bull market progresses. You tend to get that, certainly the rhetoric, and then sometimes the implementation of that in every bull market. It's not good. It's not good for either the capital attractiveness of the assets, and then of course for the DCFs, it impairs that to some degree. But I will say, kind of ironically, is that typically in the strong bull markets, even when you do get these supernormal profits tax put in place, the stocks actually usually do well, just because you're already then in a more speculative bull market phase of that market. So not that it doesn't matter. It's something you have to be very attuned to and very careful of. I don't think it's a reason to stay out of this space, though, necessarily.
All right, Adrian, anything you want to add to that? I know this.
No.
Okay.
Except that I do think Cobre Panama is going to come back at some point.
Oh, I do too. I do too. Yeah. It's too important on a global supply chain basis, and it's also too important to the GDP of Panama.
Sure, and their credit rating.
Gotcha. All right, I've got another question here. Thanks, Adam, for a great presentation. I agree. How do you think of MLPs as a way to play the cycle in energy? Any names you feel comfortable sharing? And specifically, any thoughts on Dorchester Minerals?
So look, I'm not an MLP guy. There's some reasons for that. Historically, MLPs have always kind of sat under a different umbrella. There's been some tax reasons for that, some reasons not to have it in a mutual fund. Not so much anymore, but historically the industry's kind of evolved a little bit differently. The main reason that I don't like to get involved in the MLPs today is that, if you think about where I think we can add some value, it's understanding the fundamentals, getting them right, seeing a big cycle unfold, and then getting maximum exposure to the cycle. And MLPs aren't always going to be your best way to do that. Particularly what I worry about right now in MLPs in the US a little bit is that if you have an environment where volumes are potentially flatlining or falling, the infrastructure loses its pricing power. because you have less molecules with the same amount of pipe, or even more pipe if it starts to get built. Now, every MLP is structured differently. Some have price participation, some don't. Some can make it up on the commodity price. But in general, if you're talking about the ones that are focused on volumes, there's a risk that you'd have a little bit too much infrastructure for the amount of production. And that's not a good position to be in. And we saw it in copper smelting a couple of years ago, and still to this day, where basically, for a period of time, people bought the copper story, but they said, I don't want to take the copper price risk, and I don't want to be in dirty mining. Why don't I kind of be copper light or copper adjacent, and I'll finance a smelter. And the problem is there's too many smelters for not enough mine supply. And so now these smelters at times, are willing to pay crazy prices for the copper con, in some cases, at negative margins to cover some of their fixed costs, at least with revenues. And that's I don't think it'll get that bad with the MLPs in the United States, but I do worry.
Right.
Yeah, Adrian, anything there?
No. I was going to say, why don't you, because of time, jump to the ones you think people will be most interested in? I think certainly people on your audience are very interested in silver. Do you have a particular view on silver?
So my partner Lee did some really interesting work on silver that I've not really seen anywhere else, but is true, or validated it, but I haven't seen anyone else pick up on it, which is the perception that in a gold bull market, silver outperforms. That's like kind of half the story. Typically, silver lags sharply gold, and then it catches it all up at the very end. And actually, that kind of is like the swan song to get maybe out of the precious metal sector for a little bit. So if you own silver and you want to hold it through this precious metal bull market, by the end, I think you'll be vindicated. Whether it'll perform better than silver or than gold this year or next year, in any more defined short period of time, I think is a question as to whether you think the gold bull market's ending. Because historically, when it has that catch-up rally, it's towards the end. It's more late stage in the precious metal rally, and I don't think it is. So we watch the ratio sharply or closely. We have some exposure to silver, but we prefer gold.
Yeah. And if I may, just Rich, that sort of leads to that next question. Just generally, when do you talked about when the commodity cycle is beginning, but what are the signs you look for of when a commodity cycle may be at its peak?
That's interesting, and I'll be fully transparent and honest. Part of our work on the commodity cycle, such as it is today, comes from not having called the top of the 2011 bull market. And, if you go back and you read our letters from back then, which those are a little bit harder to find, but they're out there somewhere. Why were we still bullish at the top? And we were bullish at the top because the stocks were still cheap. They'd rallied a lot, but the commodity price had rallied a lot. So on an earnings basis or DCF basis, they actually seemed like really good valuations, and the fundamentals look quite good. What we missed was the huge capital inflow that had taken place, the huge amount of productive capital that started in 3, 4, 5, and we're starting to come online by 10, 11. And that's what I think has maybe changed a little bit in our view, is that we've come to appreciate the capital cycle even more than the value cycle. And I think that we are now very attuned to that. So I'd like to hope that we will see this coming by studying the CapEx trends and the capital cycle trends, and appreciating that ultimately is what drives bear markets. But we've not started to see that money flow in yet. And so we haven't started to see, I think, a fuse lit there. Edward Chancellor, who is a wonderful economic historian and a friend of the firm, he and I once discussed that, in his opinion, a value trap is a situation where valuation screams bullish, but the capital cycle is bearish.
Interesting.
And I think that that's so telling and so true. And in fact, if you press him, he'll go on to say that actually the value factor is likely probably just spurious correlation with the capital cycle factor. Meaning, if you invest with the capital cycle factor, you're picking up what you want. Value often correlates with the capital cycle, and sometimes it doesn't. And when it doesn't, you want to stick with the capital cycle factor. That's the true signal.
Sure. And I think also you sort of hinted at it, but you talked much earlier about the lag time between new projects, new projects coming on and the production. And so the difficulty is you get increases in investment, but it doesn't actually result in any increase in supply for a number of years. And so I'm talking for myself now, not for you, but it can sort of be, you sort of get misled and you get into not exactly a zombie state, but you get into a state where nothing's happening. There's no increase in production. So yeah, I think it's critical to look at when the investments start coming in.
No, I think that's right. I think, there's kind of two phases to the bull market. I talk about it in one of two ways. You go from radically undervalued to radically overvalued. So the first half is radically undervalued to fair, and then fair to radically overvalued. You want to be more aggressive in the first half and a little bit more defensive in the second, right? You don't want to get out when it's fair valued, but you want to start becoming more defensive. And I think that when you think from the capital cycle perspective, it's the same. There's a period of time where you're just not spending enough. We're in that period now. Then you'll have a period of time where you're spending enough, but there's a lag. And you need to be, I think, a little bit more defensive, not out of the market, because there's still a lot of returns left to be made. And you've suffered through the worst parts of the bear market, so you want to make sure you're there for the bull market, but you need to be a little bit more defensive. Maybe you could start, either writing calls on some of your names, moving in on the margin, maybe to some of the larger, more integrated companies that aren't great for picking up the cycle, but can protect your downside a little more. Certain things that you can begin to do, get a little bit more cautious. But you're not there yet. You're not spending yet. So the fuse hasn't even been lit.
Right.
Yeah, Adrian will tell you my world is not the resource stocks. That's why I've hitched my wagon to Adrian, and appreciate your comments here this evening as well. I tend to focus on the physical commodities. That's what my clients are buying from me retail, and I'm getting that question all the time. Well, how am I going to know the top? And I gave a presentation on this down in Boca, just to basically let people know that we are nowhere near the top, because basically I look at gold in two buckets. One is for wealth insurance. You never sell that. You never, ever sell that unless you have a crisis. And then if you're holding it for profit, that's where you want to buy well and take profits all the way. And that's easy to do until you have to recognize when it's a dip in a bull market versus the start of the bear market. And I give a bunch of indicators that all kind of have to come together for that. Interest rates, US dollar strength, the gold price, the duration, the sentiment, political, social stability. I mean, go on and on. And none of these things are firing right now. And that's
No, none of them. Absolutely none. I completely agree with that. And, we have a long time to try to figure out what are all the indicators of a major market top. But right now, it is so clear when you look at weightings and the indices, when you look at relative price performance, when you look at, again, in this framework of a carry trade, where's the capital going? It's still going in the carry trade. It's not going into this space at all. And,
yeah. Someone asked, talking about sentiment and contrarian, someone asked about coal.
Yeah, I saw that. Yes.
I love coal.
Do coal stocks have a future?
Yeah, of course they do. Nothing's been more starved for capital than coal. Now, we have coal at about a half weight compared to gas, U.S. natural gas. And the rationale there is maybe it's expedient, I don't know. But the rationale is that, look, if energy is a growing pie, gas is going to be a growing share of a growing pie, and coal is going to be a shrinking share of a growing pie. Now, a shrinking share of a growing pie can still do quite well, particularly when it's been as starved for capital as the coal industry has been. So I don't want to be out of that market. I want to keep some exposure there. It's not the most energy efficient, nor is it the obviously cleanest source of fuel that exists. It's bested by gas in both of those. However, gas requires infrastructure. It's expensive. When you're a poor country, you burn coal. Lee likes to say that when you get richer, you start to place more emphasis on the quality of your air and things like that. I don't think that that's necessarily true. I think you always place a lot of importance on that. I just don't think
you can do anything about it.
You can do anything about it. And so then you hit this point where you can do something about it, and you do. And we see that all over the world. We've seen it in China, certainly. We've seen it in India. And gas will be a growing share of a growing pie. Coal will be a shrinking share of a growing pie. Now, at these prices and this level of capital starvation, yeah, I think you definitely can and frankly should invest in the coal space. We have some mandates that we've looked at where, even if they get comfortable with being in, the dirty resource business, they're like, just do us a favor, get rid of the coal. It's sort of like they've been the sacrificial, sector that can make it just a little bit better. That's great. You should get involved if you can. And we have, like I said, I have about a half-weight position there. And I think that it'll do very, very well. If you talk about, access to capital markets, okay, the coal industry has no access to capital markets. They're so shut out of the financial system that I don't think if you and I started a coal company tomorrow and you went to Chase and you said, I need a checking account for our business, they would let you do it. I think if
Russia
you
and
look
Iran
at,
have better access, probably.
100%. If you look, I suspect that, Consol Energy and Core Natural Resources have their corporate checking account at the Fifth and Third Bank of Topeka or something like that. It's not at Bank of America. It's certainly not at Goldman Sachs. So these guys have been all but shut out of the financial system. I remember a couple of years ago, a gas company, Canadian gas company, said to me, what do you think our cost of capital is? I said, it's infinite. So what do you mean? I said, well, look, Pioneer at the time could generate like 80% IRR by putting money into a new well, and instead they're paying a dividend. So that tells me that their cost of capital is in excess of the rate of return that they can earn on new drilling. And so what does that say about you guys? And the coal industry, the cost of capital is infinite. So that usually speaks well for an industry.
Right.
What do you think, Adrian? Do we have time for one more, or do we need to?
We should probably
kind of round robin here.
Wrap-ups, yeah.
Yeah. So the way we kind of wrap up, I like to get everybody out of here an hour and a half. That's typically what we promise. So I apologize, we're not going to get to everybody's question here this evening. But if you have a question that wasn't answered, by all means, send it to me, rcheckan@assetstrategies.com, and I'll. If you guys are amenable, Adrian, Adam, I can forward it to you and share those answers.
Sure.
But I like to kind of finish up with everybody taking a quick go around and saying, hey, this is probably, if I wanted you to leave you with one point here this evening, this is what it would be. And then also reiterating how folks can get a hold of you.
Okay.
How do we want to start?
Who do you want to start with?
We want to finish with our guest or start with our guest?
Well, finish with the guest. Okay.
That's what I think. So you want to go first, Adrian?
Yeah. Well, just to get it going. So,
Okay.
as you know, I manage accounts, global markets with a specialty in resources. Kind of humble to be here with Adam. All I'll say is to people listening, please don't give all of your resource money to Adam. Save some for us. But we also do a newsletter, and the best way to find us is adrianday.com.
All right. Rich Checkan, president of Asset Strategies. We are retail precious metals people, right? So we buy and sell gold, silver, platinum, palladium, coins, bars. We could drop it on your doorstep, put it in storage domestically or internationally, design the Perthman certificate program, still the most cost-effective, safest place to own gold, silver, and platinum, period, hands down. Personal funds or IRA funds. We deal with numismatics as well, but to a lesser extent. I just want to say, if you want to leave you with one point, that what I've been saying for 3 years, my gosh, listen to me. Gold at all-time highs is dirt cheap. Silver is even cheaper. In fact, silver's a story right now. I mean, it's up a considerable amount in a very short term. We've gotten that gold silver ratio in what, about a month, down from 100 to below 90, which is a move in the right direction. And as a result, I want to help you get some. We are at a point in 30 years where we have the lowest premiums I've seen in my entire time in this business. That tells me it is cheap and hated. I can sell junk silver, pre-1965 US silver coinage, quarters, dimes, half dollars, doesn't matter, at spot, because I could buy it below spot. And that's a far cry from August 2015 when we were selling at 60% premiums. You had to pay me in 2 days with a wire, and I had no idea when it was going to get to you, but at least 2 months. This is a whole different scenario right now. This will be an offer in the email tomorrow, but anybody that listened to this tonight, we can get you junk silver at spot. Call us to do so. And with that, I hand it over to our guest, Adam.
Well, wow, what an outro. I like that. Spot silver, junk silver at spot. I like that. Look, thank you for having me. It's a real pleasure and honor to be here, talking to insightful people on the markets. I think obviously this commodity bull market is just getting started, but importantly, I think that we're in a phase now in the markets where, given how stretched valuations are in the rest of the market, and given these huge feedback loops that have taken place, that not only is this going to be a good place for returns, it's actually going to be a very critical part of maintaining the integrity of your portfolios. And I think that's what I worry when I talk to people that are considering allocations, and it's, they have no exposure to anything outside of the carry trade. And this very much sits outside of the carry trade. I know that because I've suffered through the carry trade, not participating in it for the last several years. And I know that because in 2022, when the carry trade took a major unwind, we were one of the few areas that actually was able to benefit. So just from a simple diversification and protection, that would, I think, be probably the most important note to take away. Whether or not you can maximize your portfolio return, we all want to do that. But first and foremost, it's about safety and protection. So, certainly just think with a bit of a broader horizon than most of the financial institutions are putting forward right now.
Fantastic. And GoRosen.com.
Go Rosen.
And last but not least, before I say thank you to everybody, to include those of you that are listening, Adrian, do you want to let everybody know who's going to be up next for us on October 8th?
Why don't you? Because I don't have a date. Sorry.
Okay, so Wednesday, October 8th. If I'm wrong, I'm sorry.
Yeah.
I don't have the calendar.
It is. It's Wednesday the 8th. You're right.
Yeah, and we're going to have John Doody join us. We're looking forward to that conversation.
Gold Stock Analyst. Yeah.
Absolutely. So with that, just want to thank you, Adam. Wonderful discussion. I was looking forward to it and I was not disappointed. Adrian, as always, I continue to learn every day from you. And thank you for all those that joined us here tonight. Hopefully it was worth your while, and a full recap's coming out in the email tomorrow. Thank you.
Thank you, Adam.
Thank you.